Welcome back, everyone. Today we are covering Section 3, Investment Risk and Risk Management Strategies. We're not your financial advisors. We're not here to give you specific investment advice or recommendations. Any company that we do talk about in this section is to be taken as educational and illustrative purposes only. Here's another great quote by Warren Buffett. The most important quality for an investor is temperament, not intellect. And here's what we're going to cover in this section. Common investment risks and how to avoid them. And we avoid those risks through proper diversification, asset allocation, and rebalancing. All investments carry some type of risk. Even the safest investments carry risk, and we talked about in the last section. Before you invest any of your money, you should understand these risks. The first one, and the most common risk that investors are familiar with, is called market risk. This is a potential that an investment will drop in price if the entire market in which it trades performs poorly. The market could be the stock market if you're investing in shares of stock. Another example would be real estate if you're buying rental properties or fixer-uppers. As we saw in the stock market crash of 2008, just about every stock declined in value because the entire market was in a free fall. You could have been invested in some of the greatest companies, but since the entire market was declining, those great companies most likely declined as well. Apple was as solid of a business as there was in 2008. Just because the market was dropping did not mean the fundamental value of Apple was in jeopardy. It didn't matter how great Apple was, and it was a really great company. Since everything around it was falling, so did Apple. This is a perfect example of market risk. Business risk is the risk that a specific company will do poorly due to an unsuccessful product or service, poor management, a major lawsuit, an unfavorable news event, labor issues, etc. When an issue like this occurs, the company stock may decrease in price. This would affect a particular company, but not the market as a whole. When Equifax announced that they had a data breach, which is one of the largest data breaches in U.S. history, it had a major effect on the price of EFX stock. EFX fell from approximately $140 a share down to $90 in just a matter of days. And as you can see on the next chart, that news event had a major impact on Equifax, but not the entire market. And as you can see right here, this orange line represents the Dow Jones Industrial Average, and the blue line represents the S&P 500. And things were moving along quite nicely. And what you see right here, this major drop occurred as a result of the data breach. So this drop had a very negative impact on Equifax stock, but as you can see here, during that time when Equifax got crushed, the market as a whole, represented by the S&P 500 and the Dow Jones Industrial Average, was moving along just fine. Inflation risk is the potential that the returns on an investment will not keep pace with inflation, which is the rising cost of goods and services sold. Living is very expensive. Everything costs money, and each year those costs rise. If our investments do not at least keep pace with inflation, then we will be losing purchasing power each and every year. This means that if we have $5,000 today to buy $5,000 worth of goods this year, then next year, due to inflation eating away at our purchasing power, we may only have $4,900 to pay for those same $5,000 worth of goods. And each year, if we can't keep up with inflation, the difference in money we have to buy goods, which keeps rising in price, will expand wider and wider. And this chart shows you how inflation eats away at our purchasing power over time. Back in 1929, it would cost us $20 to fill up an entire grocery cart worth of goods. In 1960, $20 would buy us about half a grocery cart's worth of goods. 2014, we can only buy maybe a quarter's worth of a cart, that same $20. And going into 2019, $20 may only get us 2 or 3 items. And that's the impact that inflation has over time. The next risk is called industry risk. This is the risk associated with a particular industry. For example, if the company you're investing in invests in oil and gas, they would likely be affected by any good or bad news in the energy sector. Therefore, if oil prices fell, the company's stock price would likely decline. A rising tide lifts all boats, as they say, which is great if you're in a sector that has been performing very well. But if you invest too heavily into a particular sector, and if that entire sector becomes out of favor, you could be exposed to a lot of unnecessary risk. Or as Warren Buffett likes to say, you only find who is swimming naked when the tide goes out. There are dozens of sectors of the market to invest in. We don't need to invest in a million companies to have a properly diversified portfolio. So there is no need to have any more than one, maybe two companies in any given sector. Proper risk management strategies will not eliminate risks associated with investing, but they will certainly help to reduce those risks. The first risk management strategy that you should use is called diversification. When you diversify, you divide the money you've allocated to a particular asset class, such as stocks, among various categories of investments that belong to that asset class. Diversification can be used to reduce both business and inflation risk. Since you're spreading your money around in various investment categories instead of just one, the idea is that if some of the investments don't perform well, they will be offset by those investments that do perform well. Diversification, with its emphasis on variety, allows you to spread your assets around. In short, you don't put all of your investment eggs in one basket. Examples of diversification in stocks would be to invest in large cap stocks, mid cap stocks, and small cap stocks. And you can also diversify even more by investing a portion of your portfolio into the several different sectors and industries in the market, such as retail stocks, airlines, utilities, software, energy, industrials, healthcare, and consumer durables, just to name a few. Let's take a look at two investors, both of whom had $50,000 to invest over a 20-year time period, Investor A and Investor B. Investor A puts all of his eggs in one basket, and that single investment earned him 6% annually. At the end of 20 years, that single investment grew to $165,510. Not great, but it's not bad either. Investor B decides to diversify her investments, and instead of placing $50,000 into just one investment, she evenly invests $10,000 into 5 different investments. At first, she didn't do so well. The first fund lost 100% of her principal. Her second choice only earned 2%, which grew to just $14,913 in 20 years. And then the third one did marginally well at 4%, which grew to $22,226 over the 20-year time period. However, investments 4 and 5 did very well. Investment 4 earned 8% and grew to $49,268 by the end of the 20 years, and investment 5 did excellent. She earned 12% over the course of 20 years, and that investment accumulated to just under $109,000 during that time. Her original $50,000, which was diversified into 5 funds, some of which didn't do very good, grew to $195,333. As you can see, Investor B had less risk since she was diversified. She also had some investments that didn't do so well. However, those poor performers were offset by the 2 funds that earned 8% and 12% over the course of the 20 years. Another way to diversify would be to use investments that invest in several different investments with a single purchase. Examples here would be mutual funds and exchange-traded funds. Mutual funds were designed so that the average investor would be able to have the same opportunity for diversification as the large institutional investors without having the requirement of a massive investment portfolio. The number of funds that are in a single mutual fund can be anywhere from 20 companies on the low end to 200 companies on up. And index funds such as the S&P 500 or Russell 2000 have even more companies within those funds. Investing in the 200 plus companies that are in many mutual funds would require a very large investment portfolio if you were to make those purchases outside of a mutual fund. It would also be very time consuming, and the commissions to purchase those individual companies would add up to a small fortune. However, you can invest in most mutual funds with an initial investment as little as $1,000, and some fund companies have smaller initial deposit requirements as well. Another way to accomplish the type of diversification that a mutual fund offers would be to buy shares of an exchange-traded fund, more commonly known as an ETF. An ETF is a basket of securities, oftentimes they're stocks, that provide a diversified portfolio with one purchase. The management fee on an ETF is much lower than the fees associated with mutual funds. ETFs try to imitate the market indices or sectors by investing in all or a representative sample of the stocks that are in that index or sector. And unlike mutual funds where you have account minimums, usually $500 or $1,000 to buy a single fund, there are no account minimums to buy shares of an ETF. If you only want to buy one share, you can do that. Asset allocation is a risk management strategy that can be used to reduce many types of risk. It refers to the process of diversifying a portfolio not just into stocks, but into several different asset classes. This helps to reduce risk and potentially increase returns. Examples of the different types of asset classes are stocks, real estate, bonds, annuities, CDs, precious metals, and businesses. I'm 41 years old and I own a few properties, and the rest of my money is invested in stocks. My clients who are older than I am have money invested in stocks, but also more safer investments such as bonds and bank deposits. Asset allocation helps reduce the risk of major losses that can result from overemphasizing a single asset class, however resilient you might expect that class to be. Based on your age and risk tolerance, you may only want to put a small percentage of your total liquid net worth into stocks. Knowing what your risk tolerance is and what your goals are from Section 1 will help you determine what your asset allocation should be. If you have a low tolerance for risk, you may have a larger portion of your money in bonds, CDs, or other safe investments. If you have a higher tolerance for risk, you may want to invest in stocks, futures, or options. Time horizon comes into play here as well. If you have a long-term time horizon, then investing in real estate or a business may pay off big in the long term. For those with shorter time horizons, you may look to invest in more liquid investments. An asset allocation model is not something that you pick and then forget about it. It is not and should not be set in stone. When you diversify your holdings and pick an asset allocation that's appropriate for you now, that does not mean that that will be the asset allocation that will be appropriate for you in the future. Assume that you're 30 years old and you're investing for retirement. You're young and more of a risk taker in your younger years. You select an asset allocation that consists of 75% stocks, 15% of your portfolio in real estate, and 10% of the portfolio is going to be invested in options trading. That will definitely give you the potential for long-term growth. Now let's fast forward 20 years. Do you think that at the age of 50 that this is still an appropriate mix of investments? The potential returns can still be stellar, but can you accept the risk now that you are older? What would happen to your nest egg if you experience a market decline like we saw in 2008, where stocks and real estate tumbled by more than 40%? How long will it take for you to recoup those losses? But more importantly, do you have that much time to wait to recoup those losses, especially now that you're closer to retirement? The most common reason for changing your asset allocation is a change in your time horizon. As you get closer to your investment goal or investment need, such as retirement, you may need to adjust your asset allocation to account for the change in time in which your funds will be needed, as well as the level of risk you are now willing to accept. In the previous example, the 30-year-old is investing for growth, as he or she is younger and saving for a goal, which is retirement, that's a few decades away. Once that investor gets closer to retirement, a goal of capital preservation, income, or conservative growth may be more appropriate. If that's the case, a portfolio of 60% in stocks, 30% in bonds, and 10% in cash or cash equivalents may be more appropriate, or maybe even something more conservative. If your goal was to purchase a house, a shorter term goal, then the money set aside for the down payment would be ultra safe. And then once that house is purchased, you may now have another goal in mind with a different time horizon, such as college saving for your children, saving for a vacation home, or again, maybe retirement. If that new goal is a longer term goal, then your asset allocation may change from being ultra conservative to more aggressive. As new goals arise, then there is a need to reallocate your portfolio based on these goals, risk tolerance, and time horizon. These are the factors that lead to the proper asset allocation that is right for you. Now that you understand diversification and asset allocation, there's one more topic you should understand, and that's called rebalancing. Rebalancing is bringing your portfolio back to its original asset allocation mix. Since some of your investments will grow faster than others, over time the original mix of investments will start to look out of whack. Let's go back to the 30-year-old investor who has an allocation of 75% of the portfolio in stocks, 15% of the portfolio in real estate, and 10% in options. There are some option trading strategies that are very profitable. The risk of these vary depending on which type of trade that you do, but we'll talk more about that in the options trading bootcamp course. Let's say you did very well with the 10% that you allocated into options. Now that original allocation of 10% grew from 10% of the portfolio to 20% of your total portfolio. Since that represents a larger portion than what you originally thought was appropriate based on your goals, risk tolerance, and time horizon, you will need to reduce that portion of the portfolio from 20% where it is currently back to the original mix of 10%. Since this investor had 15% in real estate, and real estate doesn't move around as much as stocks, we'll assume for now that that 15% of the portfolio remained unchanged. That means that his allocation in stocks, which is originally 75% of the portfolio, is now just 65%. Rebalancing would require this investor to sell off 10% of his position in options and move the proceeds into their stock portion of the portfolio. This would rebalance the current portfolio that consists of 65% stocks currently, 15% of the portfolio in real estate, and 20% options, back to the original allocation, the more appropriate allocation of 75% in stocks, 15% in real estate, and 10% in options. Another way to accomplish this, instead of selling a portion of the options and putting the proceeds into stocks, is through adding more funds. After the options portfolio, the portfolio surged from 10% of the portfolio to 20%, and the real estate position stayed around the same at 15% of the portfolio. That resulted in an underweighted position in the stock portion of the portfolio. To bring the stock positions back up to 75% of the entire portfolio, an investor can deposit money into the account and allocate the funds from that deposit back into stocks. In this example, we are not factoring in potential transaction fees or tax ramifications. This is an illustration only for educational purposes. This is not a recommendation. Before you decide which rebalancing technique is right for you, talk to a tax and financial professional. Rebalancing is a very important aspect of proper portfolio management, but it shouldn't be a time constraint for you. Many investors rebalance on an annual basis, and some do this every 6 months. Any more than that would usually be unnecessary. The only time it wouldn't be unnecessary is when the market in which your asset classes trade are moving in an unusually fast manner. In those circumstances, it may be necessary to rebalance more often than every 6 months. Fortunately, those situations are very few and far between, so every 6 to 12 months should be sufficient. By rebalancing, you will ensure that your portfolio does not overemphasize one or more asset categories, and you will return your portfolio to a comfortable level of risk. In the following course, we will take a deeper dive into risk management. Here's your learning activity for this section. Use the 3 companies you selected from your learning activity in section 2. Find out what industries those 3 companies are in. If more than one are in the same industry, you'll need to replace that company with one that is in a different industry. We want you to start applying what you're learning, and since you just learned diversification, get used to applying diversification now. If one of your 3 companies are in the same sector, find another sector to follow. That's it for this section. We'll see you over in section number 4. Take care.